evening and welcome to The Money Show, the only daily show of its kind which brings the market's top financial experts to answer all of your financial queries. I'm Avni Raja and we've got loads lined up for you on today's show, but first here's a quick look at the headlines. Seesaw session on D Street. Nifty flits between gains and losses but stays below the 10,350 mark. Realty and metals lead gains. Small caps continue to outperform. New fund on the block, DSP BlackRock Ace NFO is currently open for subscription until the 1st of December. The portfolio consists of 45 to 55 high conviction ideas and will be sector and market cap agnostic. And you will soon be able to have a seamless travel experience through airports if you link your Aadhaar to your air tickets. Kolkata, Ahmedabad and Vijayawada airports will be implementing the pilot project of the government's Digi Yatra program from early next year. Alright, first up on the show, we've got Kalpen Parekh, President, DSP BlackRock, with us to tell us a little bit about their latest offering, which is the DSP BlackRock Ace Fund. Thanks very much, Mr. Parekh, for joining us on the show. First, tell us the new fund which you have launched. What's the rationale of this fund that's really come from the fund house after quite a long time?
Ace is actually analyst conviction equalized. And like you rightly said, in the month of February, we decided to stop taking flows in microcap purely because we felt that a great portfolio there, but a lot of new flows chasing limited liquidity could create impact cost for investors, existing as well as new, and hence we felt it was prudent to stop taking flows in that fund. And over the last 9 months, though 9 months is not really that long a time in history of markets, but in these 9 months, what we've tried to do is, give products which are interesting and innovative to our investors. So 2 months back, if you remember, we also did the Nifty Equal Weight, which is a passive fund with a slight amount of smart tweaking by giving equal weights to Nifty stocks. Coming now is Ace, where what we are trying to put together is again a very interesting concept, almost rare in the Indian market, but fairly prominent globally. We have been in business for 2 decades now, and we've been able to show alpha in the range of 5% to 9% across different product strategies in our actively managed bouquet over the last 10, 15 and 20 years. So there is a fairly consistent process that goes behind building our portfolios, and there is a reasonably experienced, well-knit team which plays this role. We thought it would be a great, interesting time right now to package together a combination of process and team along with some amount of protection in context to the fact that volatility in Indian markets are at all-time low and protection against that volatility is at an all-time cheap.
Right. So how would you say this fund is different from the other multi-cap funds that are currently offered in the industry?
I think the biggest differentiation of this fund is it has an element of protection on downside, because what we are doing is out of the 100 rupees that we mobilize, 94 rupees will go into a diversified multi-cap portfolio of stocks. However, 6 rupees will go into buying put options. So effectively, put options are available at a very cheap cost of 2% per annum, roughly around 2% per annum. We are buying these puts straight for 3 years. It means 3 years from now, for some reason, if markets turn volatile or drift downwards, these put options will tend to protect the downside of the market. So the 94% part of the portfolio gets protected by the 6 rupees which is going into buying put options. And that, to my mind, is the biggest differentiation versus all the diversified funds which are there in the market. All diversified funds, including our funds, have complete market risk. So if markets go up, they'll go up in line with markets, and they'll come down in line with markets with some element of alpha. In this product, if markets go up, this portfolio will also go up, but it will go up marginally lesser to the extent of the protection cost. But if markets fall, or if capital is broken over a 3-year period, this portfolio will attempt to protect the downside because of the put options. And that, I think, is the biggest differentiator.
And finally, what is your house call on the market? You had gone cautious some time back. Are you seeing recovery in earnings now?
We continue to, reiterate that currently we are in a cycle where valuations are looking stretched because earnings are at a cyclical low. We are at a 12-year low in terms of ROEs, which at some point in time will revert because, these are mean reverting data points. We are at a point in time where corporate profits to GDP also is at a 10-year low, which has to mean revert at some point in time. So while we recognize that valuations are expensive, but we also know, unlike the last cycle, to just give you context, we always tend to benchmark to 2007-8 cycle when we were at similar valuations. So in that phase, valuations were at 25, 26 times, but even the denominator, which was the earnings, was at a huge cyclical high. And the economy was at a cyclical high, corporate profits to GDP were at a cyclical high. So they were trending downwards, and then there was a price correction. So everything in terms of data points was at a cyclical high. At this point in time, prices are high, but earnings are taking their own time to recover. Our duty right now is to keep identifying companies which grow between 15 to 25% earnings growth, profit growth, and put it together in a portfolio. So we recognize valuations are high, which are discomforting to an extent compared to their long-term averages. But if earnings recover over the next 2-3 years, these valuations will normalize. The probability of earnings improving in this round is higher than the probability of earnings improving further in the last round because they were already at a cyclical high.
All right, we leave it there. Thanks very much, Kalpen, for joining us on the Money Show today. That was Kalpen Parekh of DSP BlackRock talking about his call as far as the market is concerned and also their new offering, the Ace Fund. But let's get our personal finance expert on board now. We are joined by PV Subramaniam, CEO Subramani.com, and we will take lots of questions on mutual funds, health insurance and more. But Mr. Subramaniam, thank you so much for joining in. Before we get into all our other discussions and questions, I wanted to ask you your view as far as the latest offering from DSP BlackRock is concerned. What is your take on the fund?
See, DSP is a good fund house and it's got good fund managers and it's got a good process. So this is a new concept. I mean, we will have to wait and see how it pans out in the market. Yes, it's a time when you have to experiment something like this, but it is a little expensive, and the 6% which is going into the buying of put options is going to definitely make the returns a little more lukewarm. But yeah, it cannot be the core of your portfolio. You will have your core portfolio and this will be one of the satellite funds. Yeah, definitely an experiment worth seeing what is happening. It's a close-ended fund, so only after 3 years you should be able to know what's happening. Hopefully it will have very little churning, so to that extent the cost could be reduced. It's a good experiment. One has to see how it pans out.
All right. So, Mr. Subramaniam, we have a lot of queries as well. But before we get to those queries, we've picked up some of the most important and most common questions that have been coming to us from several people. And I wanted to just put some of them down in front of you so that we could discuss them and get them out there. So, the first question that I have is whether investing in mutual funds through SIP makes it risk-free. Because very often with the way SIPs are talked about and pushed throughout in the market today, very often investors are confused and wonder whether the SIP is actually risk-free.
Okay, nice question, because the baseline is equities are risky. But you need to invest in equities if you want to create money for you for the long run, which means 10 years, 20 years, 30 years kind of a thing, not 2 years, 3 years kind of a thing. So what do? You go into direct equity, you run a risk. Something like Satyam can happen and your whole money can be wiped out. So you go into a mutual fund. One fund would invest in 30, 40 companies. So even if one company were to go fat, your 39 other companies would be doing well, or 29 other companies would be doing well. So that's one way of reducing risk. Even then, equity mutual fund can also be volatile. So if you put 10 lakhs for the first time, you're a first time investor, you've taken 10 lakhs and you put it in the market, goes down 20%. Then what happens? You look at 8 lakhs and you panic and you remove the money. So to reduce that, what we do is we invest it through an SIP. So shifting from direct equity to mutual fund is step 1, shifting from mutual fund lump sum to SIP is step 2. These are ways of reducing the risk. There is no way how we can eliminate risk. But unfortunately, when the mutual fund industry has been asked to put mutual funds are subject to market risk, people forget that your savings bank account has inflation risk, your PPF has inflation risk, your endowment policies have inflation risk. People forget that other products are also risky. Investing is risky, not investing is more risky. So, we are just trying to reduce risk, we can never eliminate risk.
Absolutely. And the other question, which is extremely common, is should I keep money in bank fixed deposits at all? And this is important because we see a lot of customers, a lot of investors really putting large chunks of money in fixed deposits, assuming it's safe. But this also goes back to the question, the point that you were making is that everything has risks. And even here, keeping money in fixed deposits, large chunks of money, is perhaps not a very good idea.
Yeah, actually I find it very funny that very many rich people with lots of income keep money in fixed deposits. Now let's take a 35-year-old who's got a lot of current income. Maybe he's a practicing chartered accountant or a doctor or a lawyer or he's an executive. He does not need investment income. So instead of keeping a 10 lakh rupee in a bank fixed deposit and earning 7% on that and paying 30% tax on that, if he were to keep that in a debt fund and let it just be there for next 15, 20, 30 years, obviously he might get returns which are slightly different from the bank. It might fluctuate a little. I don't think it will be very different from what he'll get in a bank, but instead of paying tax in 2017, he'll pay tax in 2047. Isn't that a great idea of just shifting your tax by 30 years? Forget 30 years, even if you do it for 4 years and 5 years, you'll pay lesser tax because you'll pay capital gains tax, which is indexed, instead of paying regular 30% tax on your current income. I seriously don't know why people shouldn't shift from bank deposits to mutual funds, especially debt. If you don't want to take any kind of risk, go into short-term duration debt funds, which have got 2-year kind of a duration, and that's it. You will not take too much of risk. Make sure that the charges that they are charging is not very high, and you will make returns very close to what you will make in the bank. Yes, there is risk because when the interest rates go down, the portfolio value goes up, but when the interest rates go up, the value of your portfolio will go down, but that's okay. It is not as bad, but you are not paying 30% tax year on year. So that's a huge advantage.
So that actually leads to the next question, which is why rewards and equities are so much higher than debt. And that goes back to the entire risk analysis and risk factor that we were talking about.
See, what happens with equity is your rewards are very high because there is amount of risk. What is the risk? When the market falls 40%, I remember sitting through the market in 1993 when the market fell 40%. Unfortunately, 2009 to 2017, we have been lulled into believing that the markets won't go down. We have had a nice long 8-year bull run, which is not a great bull run, but it has always been going up. So people believe that equities is like a PPF, but instead of 8%, you will get 11-12%. That's not true. Equity markets are not like that. So when equity markets fall 40%, if you have had the guts to stick around, next year the market will recover 50% or 60%, right? So sticking through that period, you get rewarded. So when you panic and you come out, you lose money. But if you can stick through a 5-year, 10-year, 15-year cycle and put more money when the markets are down and have the guts to stick around for a longish period, you will get huge reward because the others have run away, the others have panicked. That's the advantage of being in equity, and there's a punishment for being in equity because you could just come out and then the market could go up dramatically.
Right. Should a young person preparing for his retirement have equity in your portfolio, in their portfolio? And this is important, Mr. Subramanian, because there is also this misconception that if you're planning for your retirement, then you could, you should use only, you should have secure investments and not invest in equity. But that's really a wrong misconception to have.
See, there are two big changes which are happening. Earlier, man worked till 58 and he promptly died at 62. Now, that's not happening. A person is going to work maybe till 54, 55, then his company is going to sack him, and then he is going to live till 95, which means his money has to last next 40 years. That can happen only if he builds up an equity portfolio, because inflation was something which the retired man was told, don't bother. You're 60 years of age, you're 65 years of age, put all your money in debt, maybe have very little bit of equity, and that's good enough for you. Today, it's not good enough. You need to have equity, and if you don't learn how to buy equity right from the age of 25, suddenly you can't learn at the age of 60. So right from the age of 25, do a small SIP, maybe 1000 rupees, 2000 rupees, whatever you can, but promptly increase it by 5-10% year on year. So by the time you're 60, 65, you're comfortable with fluctuations, you're comfortable with the fact that 50% of your portfolio is in equities and you can afford to be in equities. Believe me, many of the people who are watching this program, I mean, I know the average age is less than 30, are all going to cross the age of 100. So if you live only till 62, then you need not have worried too much about your portfolio. You just lived and you spent and you died. But if you're going to live 30 years post-retirement or 40 years post-retirement, that's a scary place, and that's the time when your portfolio has to feed you. You cannot feed yourself, you're not going to be working.
So you need to have that additional bump that comes in from equities.
Absolutely, that is necessary, and when you're young, you can afford to make mistakes. No, you make 1,000 rupee SIPs, you can't go too wrong.
Right, absolutely. So equities is a big part, big component as far as your retirement portfolio is concerned, especially if you are starting retirement planning from an early age below the age of 30. But on that note, let's slip into a very quick break. We'll come back and answer all of your queries on the other side. And meanwhile, also just a reminder of a very special show that's going to be aired on the 24th of November, which is on credit and debit card fraud and how you can really protect yourself. Find out on The Money Show with Kalpesh Ashar, certified financial planner, and send us all the questions that you have as far as how to protect yourself is concerned. Welcome back. You're watching The Money Show and we have with us Mr. P.V. Subramaniam in the studio to answer all of your financial queries. Well, our question now is coming from Mahesh, who sent us this question on Twitter. He says, please suggest some mutual funds to invest in. I have 6 lakhs to invest in for a 6-year period. Mr. Subramaniam, what would be your recommendation for him? Any specific funds that you can recommend?
Before recommending a fund, I would first of all like to raise that 6 year to 10 years. Because when the markets are not at a very high, you are happy to take a 3-year, 4-year call on equities. But when it's a 6-year period that he wants to invest, I would be a little scary. If he is willing to raise it to 10 years, then my recommendation would be Franklin India Prima Plus, HDFC Equity, or iPro Discovery. Any of these funds should be good. But he should very clearly have a 10-year view. For a 6-year view, maybe he puts only about 60% of the money into an equity fund and he puts 40% or 30% into a debt fund. I wouldn't be very happy taking a 6-year view because I don't know whether the returns can be good. But over a 10-year period, I'm more confident. So if you can increase that, then these equity funds are good.
All right, we've got a caller live at this point who's with us. Ravi is calling us. Hi Ravi, thanks so much for calling The Money Show. Tell us, what's your question for Mr. Subramaniam?
Madam, please suggest. I have invested in SBI Blue Chip Fund, Axis Long Term Equity Fund, Aditya Birla Sun Life Frontline Equity Fund, ICIC Prudential Value Discovery, HDFC Midcap Opportunities. DC already had completed 2 years, madam. The duration is 8 years. I want to, from this amount, I want to complete my son's education and his marriage, madam.
Right. And Ravi, what is your time horizon? How many years away are the goals of your son's education and marriage?
8 years, madam.
Sorry, I didn't get you. How many years?
8 years.
8 years. Okay. Right. So, Mr. Subramaniam, 8 years away, he has the goal of his son's marriage as well as education. I didn't get all the names of the funds, but
I heard SBI Blue Chip,
yes,
iPro Discovery, Birla Sun Life Frontline,
and ICICI Pru Value Discovery. So,
and HDFC Midcap.
Right.
I think all the funds that you have chosen are good funds. And only thing is, if your goals are 8 years away, maybe after 5 years you start withdrawing partially instead of waiting for the 8th year. Don't wait for the 8th year. From the 5th year or 6th year onwards, start withdrawing. Like you may have done an SIP and accumulated this money. Start doing a systematic withdrawal somewhere in the 5th or 6th year and keep that money in a debt fund. So don't wait till the 8th year. Start withdrawing from the 6th, 7th, and 8th year. All the funds are good.
Right. All right, Ravi, hope that answers your questions. You too can call us and ask your questions to our guests, personal finance experts here, and we'll take them live and get them answered. Let's get across to our next question that's coming from S. Senthil Kumar, who sent us an email and asking, are there any life or health insurance schemes available for NRIs? Please brief me about the same. Again, Mr. Subramaniam, this is a very common question we get from a lot of NRIs who want to know about how to go about investing. In this case, he wants to know about insurance that he can opt for.
See, the insurance regulator very clearly operates only within the country. Okay, so the IRDA regulates all these companies within the country. So when you come to India and you disclose that you are an NRI and you get your medical done and you do your insurance, you have to understand one thing. This is a good policy which you are taking, and it will pay only within India. So you will not be able to take the money out. So if you are an NRI, actually you have more options. You may get cheaper policies from companies in Hong Kong, from US, wherever. But if you are happy with the instrument paying only in India, I think all the all the insurance companies will be happy to issue you a policy. It should not be an issue, but very clearly the amount will be payable in India. So I think all these companies will pay you, and even the health insurance, the chances are they will pay you only within the country kind of cover. If there is any foreign cover which is required, you may have to say specifically, and there the premium could be higher.
Right. Mr. Subramaniam, is there any advantage for NRIs to buy their insurance in India? Because we seem to be getting a lot of those questions.
No, I don't think so. You'd get much better and cheaper rates if you buy it abroad.
Okay.
So you'll get term insurance much cheaper, but of course they will have all the risk of if you're in the Middle East, then they might have a different kind of risk. In some parts of Africa, you may not be issued a policy. Even in India, when you're buying the policy, in some parts of Africa, they may not cover. So you need to know, you need to say all that. Please ensure that you fill the form yourself. Don't let an agent fill the form, and say the truth about your smoking habits, drinking habits, about family members, anybody dying before the age of 65. Mention all that and then take a policy. Like for example, if you're in a country where they don't cover you, no point in taking the policy.
Right. All right. Our next question is from Nilesh Patel, who has sent us an email saying, I've invested in DSP BlackRock Mutual Resources and L&T Emerging Business Fund. Can you advise whether these are good funds for the long and short term?
I think he means natural resources, not mutual resources. So, okay, these are good funds. There is absolutely no doubt. But the question is, these are not core funds. These are not the only funds in which you have to invest. You have to invest in some big large cap funds and mid cap funds, whatever, mainly, which means 60–70% of your money should be in those kind of funds. Then these are peripheral funds. So these are funds which are not the core. These are the satellites. So when we talk about a 50%, 60% kind of thing going into large cap funds, about 15–20% going into mid cap funds. Other than that, you can have some esoteric funds like this. These are both esoteric funds. So to that extent, these are good funds, but these should not be the main diet. Your main diet has to be the large cap funds and the mid cap funds.
All right, we'll leave it there. Nilesh, hope you got the answers that you were looking for. But thank you, Mr. Subramaniam, for joining us on the show and answering all of those queries. On that note, that's a wrap from all of us here at The Money Show. Thanks so much for watching. We'll be back with a brand new episode tomorrow. Stay tuned.